Welcome to Inside the Gamma Way, the greater Austin metropolitan area. My name is Douglas Goff. My mission is to help you avoid pesky pitfalls and frequent frustrations. My value is I'm going to tell you what you need to know, not what you want to hear. And my goal is to earn your confidence and help you get safely home at the right time and price. Today's message is for first-time home buyers. How can I actually get into a home and stop paying somebody else's mortgage, right? When you're paying rent and paying for a lease, they're one and the same thing. You're actually just paying for somebody else's mortgage. You're helping somebody else out. So let's start off with taking a look at what is going on in the rental markets. And this is for single-family dwellings. It doesn't include condos and townhomes. That's a different topic. From a rental perspective, if you look on the lower right-hand corner of your screen, you can see that the rent rates are ranging anywhere from $1,700 up to $6,000. And this is in the greater Austin metropolitan area, which comprises of about 5 counties. It's about a 35, 40-mile radius from the state capital located downtown. Now, your median lease rate is about $2,300. Your average lease is about $2,600. So if you're paying $2,500 a month right now or $2,600 a month for your house, you are definitely in the game to where you should or you could possibly be able to go ahead and buy a home. How am I going to do that? How are you going to do that? Well, first, let's again keep creating baselines. Let's go off of median prices. Let's see where the averages are in the sales market. And again, this is for single family dwellings within the greater Austin metropolitan area inside the Gamma Way. You can see on the lower left-hand screen, lower right-hand corner of your screen, the lowest home sold for $210,000, and the highest price last month was $1.6 million. And I round numbers up and down. What you actually see on the screen are much more accurate numbers. Well, your median sales price is $444,500, and that's getting you about 2,200 square feet. So your average price per square foot is $261. And again, it's good to know some of these numbers just so when you're looking at properties, you can start to say, am I getting a good deal or should I negotiate a little bit more? The price is a tad bit too high. And that's something that I do all day long for buyers and sellers. All right. So let's get into some of the numbers. Let's use that $444,000 purchase price and see what is actually going to cost us. How much are your monthly mortgage payments actually going to be? So instead of putting down 20%, yes, you're going to have PMI to pay for, and we'll get to that a little bit later in the video. If you just put down 5%, 5% is going to be roughly slightly higher than about $22,000 as a down payment. And you're on a 30-year mortgage and you're at a 6.25% interest payment, your monthly payments for principal and interest is going to be $2,600 a month. Right? Own a home, rent a home, pay somebody else's mortgage, or pay your own mortgage and start getting all the tax benefits to reduce your federal income tax. How are you going to do that? Let's get to some of the basics. Let's put it all off. Now, if we look at in trying to figure out mortgages, if we focus in right here on per capita income and median household income in and around the Austin area, your per capita, fancy way of saying per person, average wage earner, the median is $56,700 a year. That puts you at about what does that put you at? That puts your hourly rate somewhere around $27 an hour. So you're in a good position. You've got enough to get by. Now, the median household income in and around the Gamma Way, greater Austin metropolitan area, is at about $115,000 per year. That puts you at about $55 an hour. And the median household income right now, the median household is 2.3, 2.4 people in a home. So that's one or more wage earners. You don't have to be making $115,000 a year by yourself. If you're making $65,000 and your spouse or your partner or your roommate is making $55,000 a year, that puts you right into that median household income. And both of you want to put your money together and go ahead and purchase a home and stop paying somebody else's mortgage for them. All right. You've got two, unless you're a cash buyer, you've got two main entities, Freddie Mac and Fannie Mae, that pretty much facilitate most of the mortgages in the country. And I used to be a wholesale lender early in my career. And a wholesale lender is the person that provides the money for all of the mortgage brokers, right? And I was a mortgage broker before I became a wholesale lender. So I understand how the animal works. So let's get to it. Here we go. So what they will do is the ideal for Freddie Mac and Fannie Mae, what they would like to see is that 28% right here, 28% of your income, gross income before taxes are paid, this is all based off of the gross, 28% of that income goes towards housing. However, let's say that you don't have any other debt, or maybe you've got a car payment, or you've got student loans. They will allow you to have a total debt to income, or DTI, or DTR. Some people call it DTR, total ratio, up to 36%. That puts it into the great mortgages. You hit all the parameters, you qualify, you're set, ready to go. That's what they're looking for. So that means that you could afford by yourself up to $1,700 a month in a monthly payment towards a mortgage. However, let's say that you're in the median household income. You've got that median household income of $115,000. What does that mean? That means that you've got $41,400 to where that could all be going towards housing and all of your other debt obligations. They'll allow you to go up to that 36%. So that means that your purchasing power allows you for a monthly payment of $3,450. Most people are much more interested in what the monthly payment is going to be rather than the purchase price. As long as I can hit it within my means and it puts me at a comfortable spot, I'm good. I don't care if it's $450 or $425 or $475, right? Because in the long run, it's going to pay off. So you can get in. So that median household income ideally can go for about $3,400 a month. However, let's say that you've got a FICO score of 740. And let's say that, let's take a brief pause for a moment and talk about FICO compared to credit scores. Now you've got three main entities, which is Experian, Equifax, and TransUnion. Those are credit reporting sources. However, FICO is the Fair Isaac Corporation, and they will take all three of those credit reports along with other factors to give you a credit score or your credit risk. Now, it ranges anywhere from 350 at the low end up to 850 at the high end. If you have a FICO score of over 740, Freddie Mac and Fannie Mae and the lenders, and again, everything comes down to the lender, so all lenders are not the same, but most of them operate in a very similar fashion. Excuse me. According to Freddie Mac and Fannie Mae, they will allow you to remain compliant up to 42% of your gross income to go towards your debt obligations. It doesn't include water, pass, trash, electric, internet, gas, renter's insurance. It doesn't include credit cards, as long as you pay that credit card balance off. You don't keep a balance on your credit cards. So they will actually, so what does that do to your purchase power? Now you can actually get up to $4,025. So that same median household income with a good credit score puts you at about $4,000 a month is what you would qualify for. However, if you're below that 740 score, you're more likely going to be allowed to make payments up to about $3,600. And again, that still keeps you within that compliant range if you use $3,500 a month as your monthly mortgage. And that includes principal, interest, taxes, and insurance. Let's go back to the financial calculator for a second. Notice that your payment is right here, $2,600 a month. That's principal and interest only. Doesn't include your taxes and insurance. And unless you're paying cash for a home, the lender is going to require you to set up an escrow account to make sure that your property taxes and your homeowner's insurance is paid. They're protecting their investment in you. They're making sure that if something goes wrong, they will get their money back the same way that you would. All right. So let's go back to our spreadsheet. Come in here. All right. Now, if you're below 600 as a credit score, don't sweat it. We can still probably get you into a home within about 6 to 18 months, but that would be a discussion that you need to have with me or a financial advisor or credit professional. I can help you with that. Credit professionals are always a great place to go to do that. But my services are cost-free for that as opposed to having to pay somebody to do something like that. And I'm a single dad of 3 for over 25, almost 30 years. I'm an empty nester now, so I understand about cash flow. I understand about how to work within your budget. So here we go. Oh, in regards, what can affect your credit score? Here's something. When you're going out and you're getting ready to look for homes, you're going to need to get pre-qualified, right? You need to know what you're pre-qualified for. And pre-qualified does not mean you're pre-approved. You won't get pre-approved until that home is identified. You're going to get pre-qualified. It gives us a good idea of what's going to happen. Now, there's a difference between a soft pull and a hard pull on your credit. Let's go over and discuss what the differences are, right? A soft pull is, you're talking to somebody, they want to run a credit report on you, and, you're getting ready to move into, you're renting a home, right? And they're going to do a credit history check on you. That's a soft pull. You're not applying for a loan. You're not asking to borrow money. So the big difference between a soft pull and a hard pull is that a hard pull, you're applying for a loan, a car loan, a student loan, a business loan, any number of loans that they actually, you're asking to borrow money. Soft pulls, you can run them all day long. It's not going to affect your credit score. However, with hard pulls and when you're getting pre-qualified, please do not get more than 2 quotes. Do not let anybody do more than 2 hard pulls. Why? Because once you identify the property and you go through the process and you're getting ready to close, 10 days before the closing on that property, your lender will run another hard pull. They will do another credit history just to make sure that you didn't go out and apply for other loans. Is that going to throw you out of compliance? Well, 3 hard pulls are okay. It's not going to affect your credit score. But as soon as you do that 4th pull, you could go from a 740 credit score down to a 620. It just all depends upon so many different variables, and it's all on your own individual situation, which is is taking place. So, having 2 hard pull, and most of the mortgage brokers, you can always go to your bank and see what their rates are going to be. But unless you belong to a federal credit union sometimes can get you better rates than what a mortgage broker can. You want to use a mortgage broker. They're going to get you the best rates. Okay. Let's go into our purchase power. So we're going after a home that is about $444,500. I'm going to come in with 20% down. That's $90,000. That's a lot of coin, right? Now, me, I'm socially liberal, but I am certainly financially conservative, very conservative when it comes to my finances. And in these uncertain times that we're going into, I'm much more comfortable with putting down 5 or 10% or 3% than I am at 20%. If I've got $90,000 in the bank, I'd rather pull out 20 and hold on to 70. And I'll go into different ways on how you can achieve the same goal and use that money wisely, right? For example, this is something that a lot of people don't know. Let's say that your mortgage payment is $3,500 a month. Let's bring out my calculator. $3,500 a month. So at $3,500 a month, divide that by 12. It's $291 a month. Instead of paying the $3,500 a month for your mortgage payment, you go ahead and pay an extra $291. One extra pay, that's one extra payment a year. That's 13 payments in a 12-month period on your mortgage. That's going to reduce your interest by 7 years. That's going to take away 7 years of interest. If you add another $291 to that, and you're at that $4,083, now, all of a sudden, that 30-year mortgage is a 15-year mortgage. But let's say that life is what happens to the plans we make, right? Now, all of a sudden, you run into some tough times, and you really don't want to spend an extra $600 a month on your mortgage payment. What do? You stop making the extra payments. But you don't have to refinance. You don't need to do anything. You're already set there. Just food for thought. Let's get back to buying the home at 5% down. I like the idea of 5%. Yes, we're going to have to pay PMI, private mortgage insurance. That's fine. Well, what are my choices to actually buying a home other than putting down cash, just paying $500,000? Boom, there you go. There's your cash. That will give you a little bit more purchase power, negotiating power if you're going in that direction. But according to Freddie Mac and Fannie Mae, to avoid PMI, you need to put down 20%. So instead of 20%, you could put down 10%, 15%, 5%. FHA, if you qualify for an FHA loan, that's first-time home buyers, that requires you to put down 3.5%. Some of the mortgage brokers can still get you at 3% out of pocket, a 3% down payment. And if you're a veteran or you're wanting to live outside an urban area by at least 15 miles, you might qualify for a USDA, which is 0% out of pocket, 0% down. Again, that's for another topic. What are my closing costs and fees going to be, right? So right now, your closing costs and fees, buyer's closing costs and fees, which a lot of people don't think about, is about 2.5%. I tell everybody, budget about 2.5% of the purchase price towards your closing costs as a buyer. So that's about $11,000. Where does that money go? Well, about almost 1% goes to the title company. The title company, and in Texas, we use title companies. We don't use lawyers to facilitate the transaction and make sure everything's recorded with the county. And all the paperwork is done the way that it's supposed to protect your asset, to protect your investment. And, when you're talking about protecting your investment, we'll get to that. Lenders. You got about 0.25%, 0.25, 0.25% is going to be in, even though that you're going to be paying the title, you're going to be paying these individuals, the lender's going to require it. You're going to need to get an appraisal, and that's going to be anywhere from $450 to $650, depending upon the size of the house and where it's located. And then again, you've also got a home inspector, which is about the same amount of money. So you've got somewhere around anywhere from $900 to $1,200 in expenses right there. Those are more fees, not really based off of a percentage point. I'm just trying to break down numbers for you. Then you've got what's known as escrow. Remember when we were talking about that $2,600 a month for your principal and interest payment? Well, now you're going to have to set up your escrow. You need to pay 6 months worth of taxes in advance, and you need to pay for an insurance policy, a homeowner's insurance policy for 1 year. They're going to take all that money and they're going to stick it into an escrow account. This is what the title company is going to get set up for the lender. Lender's going to have an escrow, and they're going to hold that money to make sure that the taxes are paid and the homeowner's insurance is paid. Why do they do that? Well, if you decide to stop making your mortgage payments, or you have some problems, the only people that can supersede them from their first position of getting that money is the state, is the government, right? So they want to make sure your property taxes are paid for. 2, in case there's a fire or a hailstorm, there's damage to the house, they want to make sure that it's going to be fixed regardless of the situation that you're in. So they're protecting you and protecting their own asset, their investment in you. Something else that's good to know is, okay, what is the seller paying for? And again, everything is negotiable. You may not be aware of it, but the National Association of Realtors was sued last year. They lost the case. And so a lot of the verbiage has changed, but in reality, nothing has really changed. Everything has always been negotiable. And since this is a very solid buyer's market, sellers are not squabbling. So typically sellers' costs, they've got about 6% going towards agency. Agency is the listing agent and the buyer's agent. And typically they get 3% each. They split 6%. That's the cost to the seller. Well, the seller also has legal costs, title costs. And I tell most of my sellers to estimate at about 2%. However, half of that is for a title insurance policy. Remember how the lender is going to make sure that you've got a homeowner's insurance policy, making sure that that asset is protected? Well, the seller is going to pay for a title insurance policy. And what that does, it makes sure that everything is compliant. If something goes wrong or somebody made a mistake and there's a dispute, you've got an insurance policy to protect your asset and your claims to that property. Okay. So now we come down to PITI, principal, interest, taxes, and insurance. How does my mortgage payment actually break down? So if we've got, right now, we're at about $37.58 per month, and that's for everything. Now we're coming in with 5% down, so we're going to have private mortgage insurance, right? We're going to have private mortgage insurance. What is private mortgage insurance? This is for anybody that puts down less than 20%. This is just an added insurance policy because you're a slightly higher risk, something that you need to go ahead and pay for. Me, $228 a month for that. I mean, and again, it's going to be based off of the loan size. So if your loan size is a little bit lower, if you've got a higher credit score, this amount could be less. It could be a little bit more, but I like to take it to worst case scenario. And you'll notice this 0.0065, that is less than 1%. So that's 65. These are anything less than 1% is known as a basis point or a BPS, a basis point. And so that 65 bips times the loan amount gives you about $228 a month. Now, if I had $50,000 and I'm coming in with $35,000, that includes my down payment and all my closing costs and fees, right? I'd rather hold on to the $25,000, $30,000 because I can make more than $1,200 a month on a different investment or using it elsewhere. So I would rather keep the cash. Cash is king. Liquidity is always important. You never want to get into a situation to where, at the end of every week, you're trying to figure out how to pay the electric bill. Not a good place to be. And then you also have an HOA. Most of the properties that are being developed, there's still properties without an HOA. An HOA is a homeowners association. And for single family dwellings, now again, not condos and townhomes, it can range anywhere from about $35 to $125 a month. It depends upon the amenities inside the community and what's going on. But $65 a month is pretty common. 35 is also common, but I'm seeing more about 50, anywhere from 50 to 75. So I'm using $65 in this scenario. So all inclusive, you're at $37.50 a month. But wait a minute. Hold on, man. We were at what, $2,500 a month? Not 20. Let's change this. We were at what, $2,500 a month for the median, or $2,600 a month for the median rent rate, or the average rent rate in and around the greater Austin metropolitan area. That's $1,100 more a month in payments. Why am I going to do that? Well, let's look at your tax benefits. Right. So right now, let's say that you're making $115,000, right? $115,000 a year. That's your median household income. That's what we're using to qualify for this $445,000 purchase. And your tax rate is going to be 24%. So you're paying federal income taxes of $27,600, right? That's what it's your tax rate. You could send that to Uncle Sam, or you could be sending the money to a lender to own a home and build equity and have shelter, right? The thing I love about real estate, when we come down to basic survival needs, water, food, and shelter, I love shelter because with real estate, not only do I have a roof that I put over my head, but it's a forced savings account. Because it will grow. It always does, and it always has. There's only so much land on this planet. And anytime that you've got a limited supply amount, values will eventually always go up. Right now, we're in a pullback and we're bottoming out. And I think that we're going to start flattening out, and we're starting, depending upon the location, we're starting to see some prices rise, but we're still very, very much in a buyer's market. Yeah, unlike the seller's market, which we were, 3 years ago? Okay, back to your tax benefits. So instead of paying $27,000 in federal taxes, now you are, and you should always talk to a CPA, talk to a professional. Again, this is just me talking out of experience. Your property taxes and your property taxes and your mortgage interest can help reduce your federal income tax. It is tax deductible, right? So now we're going to take that money. We're going to take the money that you spent, the $26,000, $8,000 for the whole year. We're going to take it away from that $115,000, which is your median household income. So now your taxable income becomes $79,000, which also drops your tax rate. So instead of spending $27,000 on federal income tax, now you're only going to be paying $17,000 on your federal income tax. That reduces your federal income tax by about $10,000. So when you sit there and go, "Whoa, wait a minute, man! I'm dropping $26,000 a year on interest. What?" What you're actually paying is not that $21.99 a month. You're paying more about $13.60, because what I've done is, let's take this out, right? You take that $10,061 that you reduced in federal income taxes, divide it by 12, that's reducing your monthly payment by about $838. Right? You just have to put it up front and wait a year to start reaping some of those benefits. So right now, what would you rather be doing? Would you rather be paying $2,500 a month in rent and not getting any tax benefits? And that is based off of that's $2,500 of your net income. That's your after-tax income. If you figure out what it is for your pre-tax income, that's actually about $3,300 a month. So would you rather be spending, and what's our monthly payments? Our monthly payments are, let's put this in here, come back on up. Where are we at? $37.58, right? Let's change this. Would you rather be paying, so for $37.59, you're paying an extra $400 a month in taxes. You're paying about an extra $5,000 a month instead of renting. However, at a 4% appreciation, which is the national average for the last 30 years, and that includes all the busts and booms and the ups and downs. So about a 4% appreciation, that gives you 4% appreciation on that $450,000 purchase. So that's about $17,000 a year in savings, in equity inside your home. And again, I don't have a crystal ball. There are no guarantees. These are just all the averages. So by spending an extra $5,000 a year in your housing costs could earn you $17,000 in equity. That's a 350% return on that investment. So that's a lot. I know. If you'd like to learn more, if you'd like to find out what your options are, please go ahead and go to the link in the description below, book a time to talk or tour. My phone number is in there as well. You can always go to my website at celebrateaustinrealty.com. Again, that's celebraterealtyaustin.com. And you can register and start to search on your own, ad-free, no pop-ups, all ad-free. And I hope this has been helpful. If you've enjoyed the content, if you've gotten anything out of it, I would certainly appreciate you hitting that like button. Feel free to subscribe for more videos. I've just got started off on this platform and I'm starting to crank out videos, and I will be doing daily specials, hot deals of the day, as well as different educational material for your benefit. Otherwise, please remember, I'm here to help you avoid pesky pitfalls and frequent frustrations. I will tell you what you need to know, not what you want to hear. Douglas Goff, Berkshire Hathaway, opening doors for your lifestyle. I'm here when you need me. Make it a great day.